Welcome back, Alpha Hunters. Okay, so today's video, I'm not going to really talk too much about options, but just general market awareness and how to really understand maybe when the top of a market is in, maybe when you should look to buy some protection or other kinds of things. But we're going to look at some technical stuff, some kind of nerd out on just some data and understand when we should look to protect our portfolio for the longer term, okay? So there are three things I like to check if we are going to go down on the market in a significant value. When I mean the market, I am mostly just talking about the S&P 500. So if your idea of the market is something different, I'm mostly just going to be looking at the S&P 500 for the purpose of this video. So that is the data that I will be using. Okay, and the first thing that we want to look at is where our relationship with the current marketplace to this line that we have going up right here. Okay, this is a dotted line, and what this line represents is the long-term exponential trend line. Okay, this green line that you see waving all over the place as it goes up is the S&P 500 return or price over a given period of time. Now you see down here it goes from 1929 to pretty much recently, right at the end of December was the last time I grabbed data. It's not really a big deal for this purpose. I'm off by about 3 months. But what we can see is on this chart is we see price level at 10, 100, 1,000, 10,000. The reason why you see that is because it's an exponential or logarithmic scaling. Okay, so I am using Microsoft Excel, and if you turn that off, this is actually the price of the S&P 500, right? And so it's just parabolic, it's exponential, which is why when you turn the logarithmic scale on for any long-term chart, it kind of just normalizes it and makes it a little bit easier to read, okay? Especially for trend analysis. So this is very important to kind of keep track of. So like I was saying, the first thing I want to know is, are we extended to the upside from the long-term exponential trend line? And our current marketplace is yes, we are, okay? But how do we identify when we have stopped going higher, when we were about to roll over? And that is what the second and third check on my list is for, okay? So this lets us know, okay, we need to start looking for potentially a top in the market. And it's kind of hard to analyze like this period back in the 50s and 60s, as I really don't have charting data that goes back that far. Tried a couple different sources, and really it's just kind of hard data to get. They really want you to pay for that, go into a different service to pay for it. But TradingView does have data that goes back all the way to about 92, 93, and Thinkorswim does have data that goes all the way back. Let me scroll all the way left. Goes all the way back to what data? 83. Okay, 83. So I'm not really going to look so much on trading or on Thinkorswim on how to do this, but I was really kind of hoping to get all that data from the 50s and 60s, but it seems like it's just a little bit more of a hassle to get, and that's okay. Okay, we can look with what we were wanting to get out of this was just the data from the 90s and 2000s, 2010s. Okay, now the chart we are looking at here, this is a monthly chart. Okay, so we're looking like each one of these candles is a month. Okay, this is a longer term type time frame, and what we are definitely looking to do is save ourselves from pain of these kinds of pull downs like we had in early 2000s and we had in late 2000s. So the second check on the list that we want to know is we want the candle, this monthly candle, to contact the 10 EMA or be really close to it. By really close, I mean like almost contact it at least once, okay, on a monthly time frame. Now the third check on the list, because 2 and 3 kind of do go hand in hand, the third check on the list is we want a monthly close below the 10 EMA. Okay, so with 2 and 3 combined, we are looking for a break below the 10 EMA, which is the blue line here, this blue line. We want to break below that, But we also really, to save ourselves from more downside pain, like this full pullback in the 2000s from the tech bubble, we want it to contact the 10 EMA at least 1 month before we break below the close and close below the 10 EMA. So as we had this pullback, and this was a massive pullback, this is a drop of 14% in 1 month, but we did not contact the 10 EMA at all in any of the previous months, like not even close. The previous month was still pretty high away from the 10 EMA, and any time before that, really we didn't meet any other conditions. Okay, so we don't really meet. I'm going to zoom in here, and we're just going to kind of take this chart through history. I'm just going to kind of show you where you would want to get out. Okay, using this 3 checklist. Okay, so we're good all through here. We're still good all through here. Now we're getting to the top here. I do know that, but we're starting to contact the 10 EMA a lot, right? You start to notice we contacted a lot here in the late 99, continue to contact it here and throughout 2000, and then we get to right here. Okay, and I don't think we actually closed below it here on this candle. And the numbers I'm looking at are on the left side and that little top spot. And we actually don't close below. We're actually above it by about 0.24 points. Okay. So we then go to the next month, and that is when we close below it. We actually closed below it by 0.4 points or so. That would have been the time, to me, that is when all 3 conditions of the checklist were met. And then you can use protection. You could buy puts. Insurance, on your portfolio. You could go to cash. You could go to non-typical bullish market stocks and go to a little bit more defensive type stocks. So that would be a good time to do that. But here's another thing to kind of note. If you don't want to get out right there, you're like, all right, we barely closed below it. Maybe it's just a little knee-jerk reaction. And then we get this, you want to see what happens a little bit later. We get this pull, then we really get a sell down the next month. Okay, and just realize we will get a bounce. So we got a bounce here 2 months later after the first time we closed below it. So we closed below it on October of 2000, and then 2 months later in December of 2000, we actually had a pretty good bounce, not all the way up to where we closed below, but a pretty good. And then that would have been, hey, just understand, we're going to get a bounce, and that is when you want to start to make adjustments. Buy protection, go to cash, whichever. So that is what you want to do. And what we're really trying to do is protect ourselves from the downside. So if we look from the all-time high from this candle to the low of this bear market, we pulled down roughly 50%. Roughly 50%. So I want you to think about that with where we currently are in our current marketplace. Okay. Now, would you have been able to save yourself 50% if you would have got out right there and got in perfectly at the bottom? All right, great for you. So let's say you would have got out where the 3 checklist says to get out. You would have got out about right there, which is about right at that point. And let's say you would have said, you know what, a 40% pull down, I'll be cool with that. I'll get in. 40% pull down is about right there. 40% from where you would have got out. That's a pretty good pullback. There's plenty of spots, as you can see there, I'll just leave that there for a sec. We got all the way from July of 02 to about March of 03. Anytime in that area, you could have been buying and getting back into the stock. You would have saved yourself a 40% downside. Just 40%. And that's not from the all-time high. That's just from where the checklist said, hey, it's time to get out. It's time to buy protection. It's time to adjust the portfolio. Okay? Now, what winds up happening is people tend to think all through this time period that it's going to continue to go higher. So you're going to continue to hear things like, stay bullish and all that kind of stuff. And one of the things that people are going to say is, and financial advisors are commonly always saying this, is you need to be invested to protect yourself from inflation. They say this a lot. They say you should always be invested to protect yourself from inflation. Well, here's the thing, okay? is if inflation is 6 or 7% like it currently is in our current marketplace, and we are expecting the market to actually go down potentially 30 to 50%, 35 to 50%, I would say, somewhere in there. You know, that's, I don't know, 6% inflation, you know, it doesn't sound too bad. I'll take a 6% depreciation of my cash value rather than a 40% hit on my asset value. Okay, so just understand what the difference is between inflation and asset value loss. So inflation, you know, even though it might be kind of higher than it has been in the previous, like maybe 20 years, 40 years, you know, it's not that bad considering other alternatives, okay? So let's say you would have got in somewhere back in there, 40%, okay. You write it up, and remember, we're not super extended at this point in time from the long-term moving average. So I'll pull that back up. So that would have been us pulling all the way down to the long-term moving average right here. Okay, and then we go on another little bull run here to about 2007. So let's look at that. So let's say we would have got in there and we would have wrote it up. Now I wouldn't say we're too extended. We are on the positive side of it, but you know, it's not a big, like, we're massively extended. So I wouldn't say condition one is met where we are really extended from the long-term exponential trend line. Okay, so you're going to get into here, and there's some time periods where you're contacting the 10 EMA. So condition 2 is being met, and condition 3 actually gets met right here, but condition 1's not met. We're not really extended to the upside from the long-term moving average. Okay, it wasn't until about right here, I would say, we really started getting extended from that long-term moving average. Right, we kind of get this little thrust higher, that we really start to get a little bit more extended from the long-term moving average. And here's another thing to know, right, is this long-term exponential moving average, it is an average, right? It's an average. So we need to be above it, and we need to be below it for certain periods of time for it to be the average. So if we don't go below it certain periods of time, expect us to kind of go below it, okay? So if we need to be below it, and we're looking to be below it, I would say nowhere in here were we too extended from the long-term moving average. It wasn't until we get about right here, like I just mentioned, and then you can start looking for it, okay? So we contacted here, but you know, we just bounce back up and just keep going. And we start to hit it here, multiple times, multiple months in a row, hit it here, and then we actually close below it right here, okay? So we actually closed below it on December of 07. So December of 07. So if we look at the top of this candle from the top of the very high here. So if we look at from there all the way pullback, a 57% pullback. Okay. So if you would have got out where the 3 checks said to get out, and let's just say we're looking for a 40% pullback again, because we don't really know how far the market will go down. But 40% is not bad. You know, at least you're saving yourself a 40% downside. It might be worse, it might not. But somewhere right in there, like the bottom of this line, that's about where you would want to be buying it. Are you going to get the bottom? No. If you have another metric on how to get in, I will look for one over the next several months. But really not calling the tops, but protecting yourself at least 40% to a downside when the market is really extended hugely helps building long-term value. Whether it's just, you know, buying protection or going to cash, protecting your value is the most important thing. Okay, so when we get to the bottom, it's really hard to kind of figure that out on some of these metrics. The best thing I could say really on figuring out the bottoms is when you get a strong move, and I'm gonna look at both of these situations. When you get a really strong move down, like we had here in 2008, there's no really strong move, but this is probably the strongest move right here. About early mid 2002, that would be the time period where, okay, that's the really strong move. I'm going to look for it to then come down and break below that. And once it breaks below that, you can be back bullish. Okay, but we're not going to look too much of that in this video. I can make another video about that. And then after that, well, really, what was going on the long-term exponential moving average? Well, we were below it. So then at that point, you'd just want to be bullish. You just want to be bullish until recently. We've really started getting extended from it again, from a significant amount. So all through here, all through the 2010s and stuff, don't be looking to be bearish at all. But closing below the 10 EMA is a pretty good indication that there could be potentially more downside. We did do it here back in October of 2018. And then 2 months later, we did have a pretty dramatic sell-off in that December. But even then, we weren't too super extended at that point in time, because that was just right here. That, you know, so it wasn't super extended. This one, this is different. Okay, so this is a little different because this is COVID. This is not really a normal market cycle. This was very much a global economic shock, right? Because a lot of policies and overnight economics changed on the flip of a coin, really. So the pandemic was a little bit different. So I wouldn't worry about that. You know, you could definitely treat this a little different as you get below this 10 EMA and you say, you know what, there could be some real potential risk with this whole virus or economic situation. I didn't really think that this was going to last, and it really didn't. We kind of got back to all-time highs really even 6 months later. So it wasn't that bad of an issue. But we haven't seen the conditions that we met previously in 2000 and 2007 since then until recently. And that was actually the close of February, because we meet the condition of we are not super extended, but we are extended to the upside from the long-term exponential moving average. And then we contacted the 10 EMA in January, and then we actually closed below it for February, right? Now, if I leave the cursor on there, and then you see those two arrows for the close and the 10 EMA. The 10 EMA is at 437.35, but we actually closed below it at 436.63. So we closed below it by about 0.70 points. And that is enough for me to say, yep, we will probably be seeing another bearish market. I don't think this is going to be the one, though, like 2008, 2007, 2008, 2009. I don't think it'll be like that. I think it's going to be more like this, like we saw at the end of the tech bubble, the one we had in 2000 to early 2003, something like this, where it's just super choppy all the way down for a while. And but we'll play it the best we can. But that is what I will be. But that is what I was monitoring here recently, and I do think that it is something to note. And I just wanted to get this 3 checklists out there in a separate video for you guys. That way you can just know what you're looking for, like on a long term. Do we have markets like this where you actually need to bail out of the market? No, like they don't come around often. They really don't. Okay. Maybe once a decade, but man, saving yourself 40% to the downside, that could be pretty traumatic for your long-term wealth. If you just save yourself 40%, right? Because we pull back to the pre-COVID high, well, that's a 30% pullback. I do think we'll go a little bit lower. 40% pullback from the all-time high would be all the way back down to about right here. Right there. So that would be about a 40% pullback from the all-time high. If you pulled back 40% from where we just closed February, 40% pullback would be all the way back down to about 261-ish. And I don't know if we get back that low. Man, that is a move. I do think we'll probably get back into the lower 300 area, somewhere in the 300 area. I would say would be a good spot. A 30% pullback from the end of February would be a good spot to start getting back in. Somewhere around that 300 point level would be a good one for me. So if you do see this in the future, I do think you could use this checklist for just knowing how to manage, maybe potentially even market tops. That's really the only time I would suggest really protecting yourself, potentially even moving to cash, and just letting the market kind of devalue itself and come back on value before you step back in. Okay, and especially those things that have risen in price dramatically over that bullish time period, whichever time period it is, if it's energies, if it's tech, if it's industrials, whatever it is, you know, those are the areas that are going to be hit the hardest. Okay, you definitely want to just kind of come up with your game plan and just realize where we currently are in the marketplace. Well, we're going to get a bounce. We'll get a bounce probably up into the 420 area. You know, just start to have your game plan ready for what you want to do. Do you want to move to cash? Do you want to buy protection with puts? You know, those kinds of things. You need to figure that out. Do you want to move your portfolio around from a bullish market portfolio to a more defensive market portfolio? You know, so you need to kind of just come up with that game plan, figure out what you want to do. And if you do decide to go the puts route and you want to buy insurance on your portfolio, make sure you buy plenty of time, because this could drag out for a year and a half, 2 years. So I would definitely look to go out as far as you can on expirations and potentially look to buy insurance that far out, okay? Which is not going to be a bad thing to do. It's going to depend a lot on your tax situation and those kinds of things, on do I want to liquidate assets and would I have to pay taxes on liquidating assets and gains and those kinds of things. So buying put options probably wouldn't be a bad way to go for many people. It just depends on what kind of account you are managing and those kinds of things. But you have some time to figure out your game plan, figure out your tax situation, figure out what you want to do, figure out what the best situation is for you and your portfolio, okay? I can definitely help out in some areas of that, but I am not licensed to help out in all aspects of that. So just want to let you know that this could be a pretty significant move to the downside, and it's not going to be swift, quick, easy. It's probably going to take about a year and a half, 2 years, my estimations, to work itself out. Okay, so hope you enjoyed this. Take care, Alpha Hunters.